Anything changed, Joe?
No. And I think what Michael does is he takes a look at these things afterwards and he cuts off the front. If there's back and forth, like, hey, I can hear you, I can't hear you,
Right.
people getting their microphones straightened out and whatnot.
Okay, good.
Yeah. So yeah, um
Can you
that
see
I
can you see my cursor?
yeah, yeah, I see
Good.
moving it around. Yeah. I just found out I didn't know you could change the size and color of your cursor.
Oh, really?
Yeah.
How do you do that?
It's a setting and I think it's a right click on your screen.
I'm not going to do anything. We'll do it another time.
Yeah, your cursor will drop dead at the bottom of the screen, then you'll be worthless. Yeah, I think I can do it. I'm gonna
Did
do
you
it
see it
here.
change?
Yeah, I saw the slide change. Yeah.
I don't know if we really need to put these in there. It's not in the 101s, but I think it's good when somebody talks about themselves,
I
just
think,
for, just,
yeah, I think so too. Yeah, especially this is kind of a special edition thing.
yep.
I'm going in here and I'm seeing system components, remote desktop, optional features. Yeah, it's in the settings somewhere. Mouse.
Are we going to be able to see how many people are in?
Yeah, it does give you a count. You should
Oh, it's
see
going
that.
up. It's going up now.
Yeah, you should
We've
see the
got four
count.
people.
All right.
Hello, everybody. I'm glad you came in and started in a little bit early. We will kick this off at 6:30 today. If you have any questions, tap type them in the question and answer box or the chat. Hi, Tom. For purposes of this discussion, is a 403B treated the same as a 401k? The answer is yeah, it's very similar if you hear someone talk about a 401k. However, the 403Bs have to be transferred to a IRA or another 401k because most 403Bs don't allow you to self-direct when they set them up. But if you have a 403B and you can take a distribution or you retire or you leave your job, that 403B generally becomes available to you and you can transfer it uh, to an IRA or to another 401k that can be self-directed depending on your specific situations. We have people transfer 403Bs to us, every day. And for those of you that are on right now, I see it starting to fill up. If you have questions, feel free to um, put them in the Q&A, and if they're not pertaining to today's discussion and I don't cover them, we will get answers to you afterwards. We want today to be very informative since you guys are taking up your time this evening. And we hope that we do that. All right, we'll get going here in just about a minute. Everybody's here. A lot of people are here and keeps coming in, but we said we'd start at 6:30, and I like to be prompt. So uh, I want to thank you all on behalf of National RIA, Camaplan, and myself for attending today's Self-Direction 101 seminar. It's the first one in a series of four uh, that we're going to present. And this presentation will go through the basics of what you'll need to utilize your investing knowledge and take your money off Wall Street and into investments you understand and can control. So make it your own and understand where we're going with this. This is a class. Put your questions in the chat or the Q&A box, and we will get started. Uh, Camaplan does not provide investment advice. I want you to understand that right off the top. There will be a recording of this seminar that will be available to you probably tomorrow. Uh, so keep that in mind. Camaplan's not attorneys. We don't offer any investment advice. We don't sell any products. We're a neutral third-party administrator of IRAs. We basically let you invest in the assets that of your choice. We don't endorse anyone or any investment or any product. And we're glad to work with you and your team of advisors. If there's questions or something you didn't understand from tonight or before, we'll do a conference call with your attorney or accountant, whoever you decide uh, is best for us to talk to. Let's see. Okay. Little introduction for myself. I was born in New Jersey. I grew up in Fort Lauderdale, Florida. I went up to upstate New York, Cornell University, graduated in structural engineering, went to Kennedy Space Center, Cape Canaveral Air Force Station, was working on the research and development of the shuttle, and then a couple of commercial and military launches with the Titan rockets. In 2004, uh, I became one of the founders of Camaplan. We're on our 20th year anniversary this year, coming up in August. Uh, I've been a real estate investor. My mom and dad were real estate investors, and their moms and dads were real estate investors. So it's kind of in my DNA. I own rental property uh, in several states. I'm trying to consolidate as I get older and passing some of it on to my children. I was married in 1981 to my wife Vicky, and had four boys, and now have eight grandkids. Uh, and that's one of my obvious reasons for continuing to work. I enjoy it, and I like to help the family out. It's one of my goals. So today, in this first series, we're going to cover the basics, as I said earlier, and we'll also talk about some upcoming advanced structures and strategies in the future. We'll use this series to answer questions and provide solutions for those wanting a better understanding of all the benefits of using self-directed, right? So we'll go understanding IRAs, 401ks, and then the types of investments, the different asset classes, what's allowed, what's not, a step by step on how to do it. And we'll go over the National RIA and CAMA benefits agreement that we worked with National RIA, which obviously trickles down to everybody on this session. And then we'll talk about any questions in upcoming sessions. If you put your questions in the Q&A box, that'll be good for us, and we'll go over them at the end because we are timing this and we do want it available for recording without a lot of interruptions. Understanding what is a self-directed IRA? People ask me that all the time. This is a short uh, answer that an attorney did for us years ago. You can go on to Wikipedia. It has a much longer definition of a self-directed IRA that I think's pretty good. But the main thing, I try to keep it simple, is you get to invest in just about anything you want. Uh, and I'll talk about those, what you can invest in, basically life insurance and collectibles, a few slides into this presentation. Key benefits of having a self-directed IRA, coming from one of our clients over the past 20 years, is you get to invest in what you know and understand and can control versus using hope as your strategy. The self-directed IRA is a great way to find money for deals. It's great for raising capital for syndications. I find it exceptional for lowering your taxes while building your net worth. Some people pay taxes uh, on their earnings, while other people make earnings on their taxes using self-direction or IRAs, 401ks. And then I find it has helped myself, my family, and many of our clients uh, as a wealth accelerator uh, overall. So think about how these things can help you. If you're an individual and you're looking for money, this is a great way to talk to people and ask them if they've got IRAs or 401ks that they don't want in the market. Do they want to diversify and invest with you, or use your investment as a mini bank? And we'll go over a lot of these things um, in the future. Savvy investors come to Camaplan and open their accounts uh, to utilize their unique expertise and experience, right? Command a higher return on their retirement funds than they can get in the stock market in the more traditional areas. Types of self-directed plans. I want to talk first about the tax-deferred accounts. There's traditional IRAs. There's a spousal tax-deferred as well as a tax-free. There's a SEP IRA, which is a business IRA. A simple IRA is also a business IRA. Defined benefit plans are usually associated with businesses, as well as defined contribution plans such as 401ks and 403bs. Uh, and what a tax deferred plan does, uh, different from a tax free account, um, which I'll put up on this side, right? The traditional and the Roth is tax free, the traditional is tax deferred. But the difference between these two is, I'll take an example. Let's say you make $100,000 and you put $5,000 into your IRA. If it's a traditional IRA, you're only going to be paying taxes on 95,000 of that 100,000 that you make. And the tax-free column, with everything but the health savings account, if you make that 100,000 and put 5,000 into it, you're only going to be taxed on 100,000. So you get no deduction when you put it in. you're paying your taxes up front in that case. Except if you have a health savings account, that will be a deduction. And what now the difference is in the tax deferred accounts, you'll pull that money out, you'll pay taxes on it. So let's say you turn that 5,000 into 500,000 over 20 years. You'll have to pay tax on that 500,000 when it comes out in the tax deferred account. In the tax-free account, uh, you won't pay any tax on it when you take a distribution. So that's the difference. And I'll tell you right up front that I am a staunch uh, supporter of the tax-free side. Uh, I do have some tax deferred, but I've been converting that over the years. But I really like the tax-free because I don't know where taxes are going in the future, but I do think they're going up. So I want everybody to think about it, and we'll talk about it a little bit in this presentation, but we'll get into it in some of the follow-up ones on how and why the Roth IRAs are there. Now, the spousal IRA, if your spouse doesn't work and you do, your spouse can have an IRA and make contributions just as if they did work. And you also have a Roth-like 401k, which is part of the defined contribution plan, which is tax-free. And most of the differences between the personal ones, which is the traditional and spousal and the Roth, is there's higher contributions and basically no limits on the income that you can make to put into the SEPs and simples, defined benefit and defined contribution plans. So one of the quick questions that people ask me is, well, which account is the best? And my answer is, that's the wrong question. The question should be is how many accounts should I have? As an example, I we have clients that have multiple accounts, right? Uh, One person has traditional IRAs, Roth IRAs, health savings accounts, 401k Roth, 401k tax deferred, as well as a defined benefit plan. And people say, why do they have traditional IRAs? Why is that plural? Well, if you put a property or something with liability into it, you may only want it in one account. One liability asset, such as a house, you'll put in one IRA, and whether that's a traditional or a Roth. If you have cash or notes, as an example, in your IRAs, those don't have a lot of liability, and you can combine them together. So there are reasons to have multiples of those. 401k Roth, 401k tax deferred. Your company will put money in uh, uh, before taxes, but you can also contribute uh, uh, before or after taxes into your part of the 401k. So there's a lot of reasons. Everybody's going to have different situations based on their income, their age, their family scenario, and what they want to do going into the future. So we'll discuss more on these topics, but think about not which one is best because they're all good. Like I said, tax-free, I like better. Let's just compare a 401k to an IRA, and we'll talk about this IRA as a traditional or a Roth personal account. They all have creditor protection um, from the federal and most states. Uh, Checkbook control capability in the 401k. As the trustee of the account, you can have checkbook control if you choose without doing any new entities. Whereas with the IRA, you need to establish a LLC that the IRA is the sole member of, and then elect yourself the trustee, or better, to elect a someone other than yourself as the manager of the LLC. Solo 401k can invest in life insurance. An IRA cannot. Uh, the other feature is you have to be self-employed. If you want a solo 401k, it has to be your own company. With an IRA, you do not have to be employed. Personal loan availability for um, the solo 401k, you can check a box on the option document. In the SDIRA, the answer is no, you can't have a loan, although some people have said, well, I've been able to take my money out and use it for 60 days and get it back in. That's called a rollover. And theoretically, you could call that a loan. So that's why the asterisk is in there. Unrelated business taxable income, both the 401k and the IRA can have that. And that's if you are getting money from, as an example, you bought a Midas muffler shop or a Rita's Ice or some other business, and you're getting ordinary income. And what that means is you'll pay taxes on that, and you'll fill out IRS form 990T, or your accountant will do that for you. UDFI rules is part of the unrelated business tax income, and what that is it's unrelated debt financed income. So as an example, if you bought a property and your IRA or 401k, in this case, if either one of them bought a property and borrowed money, uh, you wouldn't have to pay unrelated debt financed income in the 401k. You would have to pay it in the IRA, because the IRS says, because you're taking money out of the economy in the IRA. And when you do that, uh, you should have to pay with it. But if you're doing it for Section 8 or government housing projects, then you don't have to pay the unrelated debt financed income. I would say don't worry about the UBTI and the UDFI until you're actually into that situation. If you're into that situation, feel free to call our office or talk to your accountant. I don't think it's a deal killer, and a lot of very wealthy people do it because uh, the UBTI tax rates go to the maximum very quickly, but the wealthy people are already in the max tax bracket. So this is just one comparison. We can compare different IRAs to business IRAs to personal IRAs. We can do solo 401ks and employer-based 401ks that are self-directed. So I'd rather do that on a one-on-one situation, because it would take too long to cover that in one of these sessions and not give you a broad base for the overall uh, basics of 401ks. Uh, I like this chart because it talks about the types of money that are out there. And we're just assuming that you make $100,000 for this example. But it's not really how much you make, it's how much you get to keep. All right. If you're making W-2 and basically you have salaries or a 1099, over here you pay federal tax, you pay state tax, you pay local tax, depending on what state you're in and what city you're in. You may or may not have a tax. Those are 0 to, I think, 10 or 12% now if you're in California, 3% if you're in Jersey, and some of these are a sliding scale as well. But in this example, between the Fed, the state, the local, and Social Security and Medicare, it's pretty easy to get to 40%. So out of that 100,000, they take 40,000 and you get to keep 60,000. And I'm going to show you a slide in a minute that's going to make a difference here. Passive income, that includes rent from apartments, single family homes, wherever rent is, royalties, interest on like a bank, interest if someone's paying you interest on a loan, or dividends, right? And then capital gains is also passive. And in this case, you get to take 75,000 because in passive income, you pay no Social Security or Medicare. So you take that 15% off. And we said 40 up here, you take 15 from 40. You're sitting at 25%. So that's why you get to keep 75,000. And we're here from National RIA, Real Estate Investors Association. So I'm assuming a lot of people are in real estate. And then let's say you do it in a traditional IRA or the tax deferred accounts. In this case, you make 100,000, but you get to keep that 100,000 until you're 73 years old, where they start making you take it out, or you can take it out sooner. But what I want you to look at here is if you get to keep the 100,000 you make, you get to reinvest that 100,000. Whereas up here, if you make the 75,000 and are able to keep it, you're already 25% behind the tax deferred account and 40% behind here. And my favorite is the last one, the tax free. You make that 100% and you pay no tax on it ever. When you pull this out, you're taxed on that distribution. So sooner or later you will pay taxes. And what I tell people is, are you going to pay tax on the seeds or the crops? That's what you want to think about. And then the other one is, don't worry about this money so much. You're living on this, so you have to do some concerns, but I've never seen the federal government or the president come down and help you get a loan or a raise, right? If you get a raise, right, the governor never does it, the mayor's never helped you, and for sure none of the doctors, uh, Social Security or Medicare people have helped you get that raise. But I'm telling you, as soon as you get that raise, they get their cut of it. You're making more money, they generally get a bigger cut. So I hope that makes sense to people. Pay attention to your tax-free Roth. If you build this, you're going to make a lot more money faster than if you use the other three. Is the thought process on that. Uh, and I wish they had taught me that in college, right? But I actually took an economics class and they told me to disregard taxes on a lot of the economics tests. And when I got out into the real world, I realized that was ridiculous. You can't disregard taxes. It changes the whole equation for you. So let's talk about account comparison, because I was just talking about those, putting that money back in that you could have. And if you start off with 50,000, the blue is in a taxable account, the green is in the tax deferred account, and the dark green is in a tax-free account. And I'm just showing you the difference if you take money out of your tax deferred account. Otherwise, the two greens would grow together, but when you take it out, you're going to have less money. So if you go out 40 years, you can see the drastic differences. There was no more money put in. It was $50,000. I forget what the interest rate return was, maybe 10%. So if you did this paying your taxes and did it in a savings account, you'd make $748,000. If you did it in an IRA, you'd make $2,262,000. That's a big difference. Any financial advisor will show you this by doing things in a Roth or in a taxable account. So none of this was taught again in college. You had to learn this on your own or through your financial advisor. But think about the only difference is at one point in your life you opened up an IRA, either a tax deferred or tax free, and you did these exact same investments. So let's talk about the types of things you can invest in, right? Now think about you got your IRA, you figured out which accounts you want to have, you open those accounts. Now you say, what do I want to invest in? Am I good at real estate? Sure. Have I ever done notes or mortgages? I have done some of those, but I'm better in real estate or I'm better in notes. Private placements, syndications, maybe in a multi-family investment. Uh, Anthony Charo talks a lot about those. Maybe I like precious metals or I want to be diversified. I can buy real gold and silver and keep them in a depository. And then there's a whole lot of other things out there. If you're not sure uh, what they are, call our office. We'll talk to you about them. But basically, everything is on the table with the exception of life insurance and collectibles. Um, So a lot of our clients, I'd say a third of them do real estate and purchase rental properties in their IRA's names. Um, a lot of them will do notes and mortgages, basically turning their IRAs into mini banks. Some people like that better than holding the real estate because it's easier and the money comes in. I have a good friend out there that says, which would you rather have, a rent check or a mortgage payment? And he says mortgage payments because I don't have to deal with the toilets, tenants, and the trash, and I still get mailbox money. Other people will form LLCs and put three, four, five, or more people together, and they'll buy more expensive properties. If you want to go from single family homes into multifamily, a lot of times you'll do a private placement or a syndication uh, with other people that you know. And you can put some of your own money in there as well as your IRA money. And then precious metals, that's your choice. A lot of the wealthy buy the precious metals as a store of wealth so that they can do that. I've heard of people buying trees in South America, Central America, in their IRAs. So the options are basically endless when you talk about it. And then in this next chart, we'll talk about just some of the real estate if you really want to be diversified, right? Single family or multi-unit homes, apartments, condominiums, singles or whole buildings, commercial property. Maybe that's warehouse property is hot right now. Could be industrial property that you can rent out. It can be improved or unimproved land. It can be leveraged or unleveraged, meaning it has a loan or not a loan on it. And you can buy property in foreign countries with your with your with your IRAs, 401ks. Notes and mortgages, right? Deeds of trusts, promissory notes. Some people will actually buy leases uh, for notes, right? Convertible notes, discounted notes back in 2008 and 9 when there was a lot of foreclosures and non-performing notes. The banks would sell these notes at 5 and 10 cents on the dollar in a lot of cases, sometimes more. And then there's secured and unsecured notes. I'd be very careful with the unsecured notes because uh, it's almost like a credit card. If they don't pay you, it's hard to get the money back. And secured, you can take the collateral, generally foreclose on a property, or um, take it out of escrow, etc. Allowable investments, private placements. So we were talking about LLCs, general partners, and limited partners. Most of the time, the IRA is a limited partner. Uh, you can have beneficial interest in trusts. You can have interest in corporations, just not S corp corporations. Your IRAs can do joint ventures. They can buy structured settlements. A lot of them are in investment clubs, and and a lot of them are in hedge funds. So I just want you to know that think about whatever you're good at and use these for your investments because you know and understand them because they will then have the least risk, in my opinion. Allowable in gold, silver, palladium, platinum, uh, precious metals, composite, where you can buy all of them together. Uh, there are some restrictions and some gold and silver. It has to be very pure, with the exception of the American Eagle. Let us know what you're thinking of buying, uh, and we'll let you know if it's on if it's not a disqualified uh, metal. All right, so we talked about the prohibited investments that I talked about earlier. I told you collectibles and life insurance, works of arts, rugs, antiques. It says any metal. We just talked about some metals that are there. Gems are disqualified. Stamps and coin collections, alcohol beverages in most cases are prohibited. I've got the exception up there for the metals that we just talked about. So let's talk about some examples of prohibited uh, by the IRS, right? Your IRA uh, can't do a transaction between a qualified a disqualified person, and I'll get to who's disqualified in a minute. So you can't sell, exchange, or lease property to disqualified people. And right off the bat, you're disqualified. You can't sell or move a piece of property you own into your IRA. Your IRA cannot lend you money, and you cannot lend your IRA money. You can't furnish goods or services or facilities to anything that your IRA owns personally, or your IRA can't provide that for anything you own personally, and whoever else is disqualified. So if you're doing a rehab on a piece of property and uh, you have a construction company, your construction company cannot be doing the work on your IRA owned property. Uh, Two things to understand with IRAs and real estate. What gets most people in trouble is no self-dealing. Do not lend money for it. Do not sign on the loan for the property. It has to be non-recourse. Um, don't use your company or any other disqualified person's company to do any work on it. And don't use your property. Don't think you're going to buy a property at the Jersey Shore or at the beach in Delaware or California and use it when it's not rented. That's not allowed. And if the IRS finds out about it, then your IRA can be disqualified as a result of it. We're not going to report it to the IRS. However, uh, a lot of times, um, people that know you, I've seen a case where a husband and wife had bought the property, right? And the husband ends up with it, or the wife ends up with it, and the other spouse turns them into the IRS. Family members sometimes do that, and that's where a lot of the IRS gets its information from when they find people uh, not doing their taxes properly. I don't think the IRS is flying drones around yet, but based on what I've heard from different attorneys, someone turns them in. Let me just, okay, disqualified persons. That's what we were just talking about. Put yourself in the middle here. You're the account holder. You are definitely disqualified. Your parents are disqualified, and your grandparents are disqualified. Right. Your children are disqualified and your grandchildren are disqualified. That's lineal ascension and lineal descension, right? Spouses of those disqualified people are also uh, disqualified. Your spouse is disqualified. Uh, your aunts and uncles are not disqualified. Your cousins, your brothers and sisters, your nieces and nephews, they're not ascending. They're off to the sides. So the ones in green are okay. The ones in blue are not okay. They're disqualified, and your IRA cannot do business with them. So corporations, partners, any trustees, estate administrators, uh, are also all disqualified persons. I don't want to dwell on this chart because it's, don't get into the gray, sketchy areas because this tool is too good too good of a wealth builder to mess it up and have it distributed at the year you do it. How does the process work? It's pretty simple. The first thing you do is open up an account. You can do that online. You can ask for paper. Uh, there's several ways to do it. You just go to the Camera Plan website. Then you fund your account, right? You get money into it. You can make a contribution for the year. You can transfer it from an existing IRA. You can transfer all of it or a part of it, or you can roll it over from a 401k or another employer plan, such as a 403b or a defined benefit plan, whatever it takes to fund your account, or you can do all three of them. And then you're going to choose your investment. We just went through the investments, probably real estate, or maybe you're going to do a note for somebody else that bought real estate in their IRA, or somebody else that's buying a car. Uh, Whatever your investment choice is, that will go in here and that paperwork will be generated for that. Maybe private placement memorandums and operating agreements that you sign, right? Then you're going to make your investment. You're going to use the paperwork that the investment provider gives you, whether that's a real estate contract or a note and mortgage or a deed of trust, or if it's that paperwork is going to be made in the name of your IRA and it's going to be vested Camera Plan for the benefit of John's IRA or Mary's IRA, right? Once you've done that and signed that paper as read and approved, we will sign on behalf of your IRA, and we will send that money to either the borrower if it's a note, or the seller or the title company that's doing it if you're buying real estate, or to the fund manager if you're doing a LLC or a general partner or limited partnership, etc. This paperwork and who we send it to will be dictated by the paperwork that you sign. Then the next thing you do is you sit back and you go online whenever your payments are supposed to come in. Your payments will be posted to your account within 24 hours of us receiving them. And you can check online as well as get a email from us every time a deposit is made. So it's pretty simple uh, to do, and people do it every single day. So what does Camera Plan do? The IRS requires you to use a third party. So that's the reason we're in business, because we make it easy for you to use your IRA. Vanguard, Fidelity, they could do it, but they don't. They actually call they actually have a self-directed IRA, but their self-directed IRA, you can only invest in what they sell. And as I said earlier, we don't sell anything. We don't have any investments to sell. So you have to find what you're going to buy. So theirs is not a truly self-directed IRAs. Theirs is what I call menu-driven IRA. You can only invest in what they sell. We don't give any investment advice, nor do we have products to sell. We do all the IRS approved paperwork for you to have for your tax-free or tax-deferred accounts, and so that you're allowed to invest in these different alternative investments. We keep records of the transactions and report that to the IRS and you yearly, and we want to be part of your core team of professionals. Now we're the preferred IRA company with National RIA last fall. We came into that position and they negotiated a couple things with us. You can open up a new account and fund it for $25. We have no annual fees until you do your first deal. And if you're sitting in cash, there'll still not be an annual fee. So don't worry about that. Get your account open so that you're ready to do a deal when one comes along with you, as well as being a free consultation with a Gamma Plan founder. That would be myself, and that'll be myself and or my sister Maggie, who's the other co-founder. We give 1 year VIP customer service and one free expedited transaction. If you come in and you need something done in 24 hours, you're allowed to use this get out of jail free card and move it to the front of the line. And then we do 2 complimentary outgoing wires. Uh, Tim put in a question, how are you paid for your services? That actually should be in here. It would be a nice thing to do, but basically, when you open up an account, you'll see our fee sheet. We charge either based on the value of your account or the number of assets in your account, and you can make that decision. And you can change it, I think, 10 times a year. So as an example, if somebody comes in and buys a $1 million property, it's $300 a year. If they buy a $100,000 property, it's $300 a year, because it doesn't take us to do any more work. My sister and I, as I said, Maggie, the co-founder, we built our fee sheet to be the way we would want it as investors. So we give people the choice. You can do it with you know, based on the value of your account. But I don't like that approach because I make money. I don't think that I should have to pay my administrator because I do that. But we'll leave it there. You can change it back and forth. Where are you located? The the headquarters is located in Pennsylvania, right outside of Philadelphia, in Ambler, PA. But we have national, and most of the stuff can be done online now. And we've got a great portal that you can go to and work with. Let's go to the next slide here. So any other questions, type them in here. But this is what some of the most ones that we get. Am I able, Tom Ryan says, am I able to visit your office? We have walk-ins every single day. So yes, you are. We have live classes at least once a week, I think on Wednesdays at noon. And obviously you can call up and set up an appointment to come to the office. Warminster, you're not far at all. Yep, feel free to come over, see our academy. or have a meeting with one of our account executives. Do you have an interest-bearing account while cash is parked? We do not have an interest-bearing account when the cash is parked, but you can put it in an account. Most of our people, I mean, in the past 14 years, there wasn't enough money in the bank accounts. It was less than 1%, so it wasn't an issue. And I understand that people um, are uh, getting more interest now. I think you can get maybe 5%, but the answer is we don't have one right now. However, if you do want that, you can keep it in your account where it is, and then a week before you're going to do a deal, or 2 weeks before, do a transfer there, and do it. Most of our people keep their money working uh, when they open up the account, but you can transfer it back to another IRA or to a money market account. And I want to answer your guys' questions before I go into these, but what is the timeline to open an account? Basically, to open the account, it's done in 10 minutes after you fill out the enroll form online, and you'll get an email unless we find something wrong in the know your customer search on you. And how long does it take to fund the IRA? Most people can get the funding over within 2 weeks. However, Pershing and a couple other people on IRA transfers take up to a month. Some 401ks will also take up to a month. So uh, just take that into account. How do I fund an IRA account? We talked about that in there. Contributions, transfers, or rollovers from 401ks. And we talked about how long that takes. I talked you through how I invest in an asset a couple of charts ago. You open up the account, you fund it, then you find that paperwork. Either it's a sale contract for a property, or it's a note and mortgage for a note, or it's a uh, private placement memorandum for an LLC or some fund. You sign that work, and where you'd put your name normally, you'll put Plan for the benefit of your name IRA. Who signs the paperwork when I invest? Great question. Uh, we're going to sign it for your IRA, but you're going to sign it ahead of us that said, yes, you read and approved this paperwork, and you're going to fill out another piece of our paperwork that says you're authorizing us to sign and send the money. Your IRA is titled Plan for the benefit of your name. Can I use my IRA for the down payment of a property I want to own personally? The answer is no. You can't. That would be considered borrowing the money from your IRA. If you put the money down as a down payment, then the IRA is going to own it if that's the only place where the money came from. You can go into it, but as an example, if you were going to buy it 50-50 with your IRA could put 50% of the down payment and 50% of the and get a note, a non-recourse note for the property. You cannot sign personally for a note. Uh, Let me go. Can my IRA receive a loan to purchase a property? Yes, it can. It can come from a bank. It can come from another IRA. It can come from a business. So yes, it has to be non-recourse, which means it's not going to be based on your credit, and it means they can't get any judgments against you or the IRA. Can my IRA receive a loan can I manage a property my IRA owns? That's a little bit stickier, but the answer is you can make a lot of decisions there, but you can't touch the money. The money needs to go to a property manager and or a and or a um, or back to the IRA. Uh, but you can talk to any people doing work on the property. You can have the IRA cut a check to any vendor or carpenter or plumber that needs money. They can either ACH or wire the money right to the contractor, or they can send a check to you made out to the contractor for you to go over and check the work before you give it to them. So the operations, and we're probably one of the best companies when that's there. What do I do if and when there is a capital call? At that point, you'll fill out a form that says send the capital to whatever instructions they want it at, a wire generally to the bank, and we'll do that after you authorize it. Um, so any other questions that people have? We're going to do 3 more sessions after today's. This webinar will be recorded. Feel free to shoot questions into us or call us or set up a consult, all of which is free. But our next sessions are going to be on UBIT because we got a lot of questions on that from a lot of National RIA uh, members that have had IRAs for years and didn't know what it was or how it worked. The second one coming, or the third one that we're doing, is jumpstarting your IRA, how to take a little bit of money and turn it into a lot quick, because a lot of people say, well, the only IRA I'm eligible for is a personal one. I have a job and I can only put 6 or 7,000 into it for a year. We're going to show you how to jumpstart that. And we actually have about 25 ways to do that, and we'll cover that. And then we're going to talk about exit strategies. How do you get your money out? Everybody says, well, I have to wait till I'm 59 years old to get the money out without any penalties. Well, there are ways around that, and we'll discuss those. And then we're going to talk about asset protection with your IRAs, 401ks, and how that's handled. A lot of the ones that are out there, you have a lot of built-in asset protection, as we talked about earlier. O.J. Simpson, for those of you that know him, he was sued by his wife's family for a wrongful death, and they won, but they couldn't take any of his money because it was all tied up into his NFL 401k plan. So we'll discuss some of those strategies and where we're going with those. But I wanted you have to start off with the basics, get your account, and then these will make more sense to you after you have your account and have been working in this arena. So the next session, how our IRAs and 401ks can borrow money from banks and others, understanding the UBIT and UDFI, and when does it come into play, who pays that, and how much, and when is it paid, how do you block it legally, what strategies and systems are in place to do that, and why UBIT and UDFI are not deal killers, especially for the wealthy. And we'll talk a little bit about Mitt Romney's $1 million IRA and Peter Thiel's $1 trillion Roth IRA. When we talk about those reasons. So everything I took today, we talked about, came from these publications. If you don't believe me, and you have a problem sleeping, just pick up any of these publications and start reading them. We've got some private letter rulings and court cases on our website as well, that goes into this. And the reason I put this up is because when I started in this business, uh, or with self-directed IRAs in the mid 1990s, there was no information. Nobody would give me a list like this. There were no books. There were no articles uh, that would give this type of information. People didn't even know what it was called. Google wasn't around. Uh, Wikipedia wasn't around. So it was tough to get this, but if you feel like it, grab those publications. This will be recorded and on there. Um, Email or call to talk to an account executive will help you get your accounts open. Just email Engage and you'll be assigned an account executive there. You can go to our website, www.camaplan.com. When you call in, identify yourself as a National RIA member or your local RIA member, wherever you've signed up, so that we've got that, and we'll make sure that you get the savings on the on opening the account. So at this point, I would say we've used up our time. I don't see um, okay, do see another one. How do I know when I have to take required distributions from my IRA? Well, one is if you have a Roth, you don't. If you have a traditional IRA, then you have to take it when you're 73 years old if you're not taking them right now. And on top of that, we'll send you a letter notifying that you have to take you're of the age that you have to take a required distribution. And if you're not sure, you can always ask your CPA uh, about it as well. But feel free to call the office and ask us for any of those informations that you have, and we'll be glad to answer it for you. If you have a inherited IRA, you most likely have to start taking distributions now, but you also have to take that money out of your inherited IRA if it was set up after 2019. So I hope that answered your question. Can I put bank money market account in an IRA? Uh, you have to check, can you put your money, can you put your IRA money in a money market account? Uh, you can, I think at different brokerage houses. We don't do it here. And what I would say, if you're going to do that, put your IRA money in that money market account. And then when you need it, bring it back to us. But again, you're only going to make 5%. And what I'll do for these questions is I'll bring up a chart at the next session to talk about that. 5% money is way better than it was, in the past, 15 years. But what I want to caution you on, it's not as good as 10 or 15%. It's quite a bit lower on that. But I will make a chart. We have one. I just don't have it on tonight to talk about the differences between 5, 10, and 15%. And 5% really isn't going to make a big difference in your life. 10%, is much better, and it's more than twice as good over time. So I will definitely put that in next week's presentation, or you can call our office and we'll send it to you, and it's in an Excel chart, and you can actually manipulate the Excel chart to change the assumptions on that chart by clicking a couple of numbers. Thank you guys for being here tonight. Any other answers we'll take at the office in either a consult, Zoom call, or a phone call that you can schedule. Appreciate it. Have a good night.